One quiet number changed everything. At 51, a man looked at his finances and found something most people chase for decades. Not 5, not 15, more than half a century. If he stopped working immediately, his money could carry him for more than 50 years. But the strange part was this. He never chased a magic stock, never claimed perfect investing skill, and never built his life around market predictions. His advantage was almost boring. He controlled spending, invested relentlessly, and refused to panic when markets stopped rewarding him. While others searched for the next winning asset, he tracked one brutal question. How many years can my money buy me? That question exposed the lie behind most dreams of freedom. Freedom was not comfort first. It was sacrifice first. Most people imagine financial freedom as escape. No boss, no alarm, no fear. But the harder truth is that freedom is built before it feels good. It is built when income rises and lifestyle does not rise with it. It is built when temptation screams louder than discipline. It is built when markets go nowhere and you still keep adding money. This investor did not begin as a money expert. In his 20s, he knew almost nothing about managing wealth. He began learning in his early 30s on his own, without a perfect system or grand philosophy. He simply wanted a secure retirement because retirement frightened him deeply. Fear became fuel. When he first calculated how much he needed, the required investment was far beyond what he could afford. That is where most people quit. He did not quit. His first lesson was not about returns. It was about behavior. At the beginning, he believed logic would be enough. If people understood money, they would invest regularly. If they knew markets were volatile, they would stay calm. If they saw the math, they would stop chasing trends. Then he watched real investors under pressure. Fear of missing out took over. Patience disappeared. Discipline broke faster than spreadsheets predicted. The market did not defeat them first. That was the first shock. So instead of tracking net worth like a scoreboard, he tracked something more personal. How long would his current wealth sustain his life if work stopped today? That single number mattered more than every headline, every index, and every hot tip. At age 51, his answer was more than 50 years. His money was built to outlive him. That became his real definition of retirement security. He had not started with a target like 30 times expenses or 40 times expenses. Those numbers came later, mainly because others needed a framework. His actual journey was simpler. Invest enough, keep going. Let career growth help. Let time work. Let markets contribute when they choose. And for years, he did not even check whether he had crossed financial independence. When the early retirement craze became louder, he finally measured his position. The discovery was almost accidental. He had crossed the line long before he noticed. That is the hidden power of boring discipline. His review process stayed simple. Once a year, he seriously examined the portfolio. He watched allocation while investing, but he did not constantly interfere. If an asset moved more than 5% away from plan, he rebalanced firmly. Taxes did not become an excuse to avoid action. The system was dull. That dullness protected him. But the second lesson was harsher. A bull market makes everyone feel intelligent. After COVID, millions of new trading and investing accounts opened worldwide. New investors entered during a period when assets seemed unstoppable. Many became wealthy on paper quickly. Then the market slowed, flattened, and taught them what risk actually means. Risk is not just a sudden 30% or 40% crash. A crash is painful, but at least it is dramatic. The deeper test is time. Can you watch your money stay underwater for years? Can you keep investing when 2 full years pass with little or no reward? Can you continue when nobody around you feels smart anymore? Markets test boredom brutally. He divides market pain into 2 kinds. Return risk is when prices swing violently up and down. Big gains and sharp losses often arrive close together. That kind of movement can be handled with preparation. Time risk is different. It is the long desert where nothing seems to happen. No excitement. No proof. No applause. That desert breaks investors because it attacks hope slowly. After 1 weak year, people question their plan. After 2, they attack the entire idea of investing. They say recurring investments do not work. They say regular people should stay away from markets. They demand a crash to fix what they do not understand. But nothing unusual has happened. History has always contained flat markets, sideways markets, bear markets, and long stretches of disappointment. Every generation thinks its pain is new. The charts disagree. This is why chasing whatever shines is dangerous. 1 year, everyone talks about gold. Another year, international stocks become the obsession. People do not ask whether an asset fits their plan. They ask because it recently performed well. By then, the easy money may already be gone. A rising asset feels safe precisely when it may be most crowded. Gold can spend years disappointing investors. Global equities can fall out of favor. Every asset has winter. The real question is not whether you want the upside. It is whether you can survive the ugly phase without abandoning it. That question exposes amateurs. Diversification is not about owning everything people discuss. It is about controlling the movement of the whole portfolio. Most investors stare at isolated returns. This fund did well, that asset failed, this stock doubled. But wealth is not built by celebrating pieces. It is protected by seeing the whole machine. The third lesson cuts into lifestyle. Many people think financial freedom is possible after buying everything they desire. The better home, the better car, the bigger vacations, the upgraded life that income seems to justify. Then they plan to invest whatever remains. Usually, very little remains. As income grows, lifestyle inflation sneaks in, wearing the mask of self-respect. People tell themselves they have earned comfort, they deserve the upgrade, they have worked hard. All of that may be true, but math does not care. If spending expands with income, investing never catches up. For ordinary earners, freedom demands trade-offs. Not misery, not extreme deprivation, but conscious limits. Wants must be questioned. Loans must be treated carefully. Retirement must not be pushed behind every visible desire. That is the trap. Housing debt is especially emotional. Buying a home with a loan can be reasonable. The mistake is letting the payments swallow the future. A practical guardrail is keeping home payments near 30% of take-home income. If 2 earners are involved, use combined take-home income. Stretching toward 35% may work for some, but beyond that, retirement planning gets squeezed. The house begins to look like success, while quietly starving the future. Then comes another mistake. People rush to repay the loan early because the interest number looks terrifying. They add every interest payment across 15 years and feel cheated. But money paid over time is not the same as money paid today. Time value matters. A better method is psychological and financial. Keep paying the regular installment. Create a separate loan closure fund. Put bonuses and extra cash there. If a job loss happens, that fund can reduce or close the loan. If the job continues, investments may grow alongside the debt. This protects both fear and future. Debt used for needs can be acceptable. A computer for education, transport for work, or tools that protect income may be necessary. But debt for wants is different. One powerful affordability test says this: if you must debate whether you can buy it, you probably cannot afford it. True affordability does not create mental strain. Retirement math does not need to be mysterious. Start with today's annual essential expenses for yourself and your partner. Remove costs that will not continue, such as child support or dependent-specific spending. Assume expenses double every 10 years. That reflects roughly 7% inflation. Then estimate expenses at retirement and multiply by at least 33. That links to a withdrawal rate around 3.5%. The withdrawal rate is annual retirement spending divided by total retirement corpus. This is not perfection. It is a serious starting point. There is an even simpler check. If you can invest at least 50% of your current essential annual expenses toward retirement, including retirement account contributions, you may be on track. Then, try increasing investments by 5% to 10% whenever possible. The percentage matters because it reveals the truth, not what you hope, not what you tell yourself, what your behavior is actually buying. For someone starting late, say around 45, the answer is not panic. A massive retirement calculation may destroy sleep before it improves behavior. First, protect health, because poor health can ruin every financial plan. Then, accept that retirement may need to be delayed. A second career, consulting, freelance work, or part-time income can reduce pressure after leaving full-time work. The mantra does not change with age. Invest as much as possible. The older the start, the more important lifestyle control becomes. And no, he does not consider himself the ideal investor. His portfolio is not perfectly diversified. It has no gold. It has very little international equity in the retirement portion. He avoids adding too many asset classes because every new asset creates more decisions, more rebalancing, and more confusion. His real superpower is discipline, not brilliance, discipline. The final strategy is brutally simple. Build the plan, then stop worshiping market noise. Once goals are listed, emergency money is ready, insurance is handled, and asset allocation is chosen, less information may be better. For long-term goals, constant market watching creates anxiety, not wealth. Instead of asking what the market did today, ask what you invested this month. If you invested $10,000 last month, can you make it $10,100 this month? If you cannot increase monthly, can you increase quarterly? The habit matters because wealth grows from money deployed again and again. Markets may fall after you invest. Assume they will. That belief removes the need for perfect timing. If you stay invested, you cannot miss the next bull run. So, the strategy is not glamorous. Control lifestyle. Ignore envy. Keep adding money. Freedom belongs to the person who can repeat that when nobody is cheering. Freedom is not bought by the person who earns the most. It is built by the person who can say no the longest. The market rewards money, but freedom rewards restraint.